Bueno. Bueno. We represent the Tecnológico de Monterrey from Monterrey campus, and we analyze José Cuervo, a company that produces, sells, and distributes spirits. José Cuervo's portfolio consists of 30 different brands, where tequila represents a major proportion of 57% in net sales. By region, the major proportion is represented by Canada and the United States, with 62% in net sales. The conclusion of our analysis is a sell recommendation, with a target price of 29.2 pesos. The foundation of our analysis is the following statements: family control, managerial decisions, a highly competitive industry, and irregular financial results. With the family control, Beckman family has 85% of the shares outstanding, and the rest is free flow. This implies a high liquidity risk and the possibility the Beckman family hasn't taken the best decisions for the company. There has been questionable managerial decisions. Since their initial public offer in February 2017, there has been rising alerts. The CFO resigned. By September of this year, the CFO from Volaris was hired as the new José Cuervo CFO. Rising alerts as how the CFO from a different industry can manage this company. Also, the United States CEO resigned, and currently the position hasn't been taken. The recent acquisition of Parental Investment and the Julio investments have been the best for the company. These rise alerts as how the companies is making their decisions.
Porter analysis. For the trade of new entrants, we consider three main things: the appellation of origin for agave, the control of distribution in Mexico, and Cuervo as an experienced tequila producer. For the substitutes, the company deals with many competitors and with many products in the same segment of market spirits. And for the bargaining power of customers, Cuervo has a low buyer concentration located in companies like supermarkets or restaurants. For suppliers, the company maintains a minimum of 3 suppliers for its main materials, and also, as reported by Cuervo, 80% of its main materials were acquired for 67 suppliers in 2017. On the other hand, the industry rivalry is highly concentrated in the tequila market in 4 companies. The tequila market share is mainly represented by José Cuervo with 29.7%. And regarding to the sales growth volume in the second quarter of 2018, José Cuervo don't represent any improvement in comparison with other brands like Don Julio, El Jimador, or Tequila Herradura. Comparing the main competitors of Becle, we can find that other companies has a bigger asset value and a bigger market capitalization, which means that they have better opportunities to buy better brands. And in the industry analysis, according with Euromonitor, the historic compounding annual growth in the main spirit category, tequila, mezcal, and whiskey, has a growth of 4%, about 4%, and the forecast compounding annual growth is still showing improvements.
Looking at the financial results, we also see some issues that we think support the sell recommendation. So first of all, if we look at the revenues, we see that the growth rate has been declining since the IPO. This is mainly caused by the decrease in the negative evolution of the volume sold in the US and Canada. In 2017, the company decided to increase the price of its portfolio, and this caused the distributors to overstock. This effect was especially relevant in the United States and also in Canada. Well, no, not in Canada, sorry, in the United States, where there is a 3-level distribution system, and in this case, all 3 levels decided to overstock. The growth rate hasn't recovered fully yet. The net sales, however, have been increasing yearly. This is caused by the increase in the price, and however, we do not think this strategy is sustainable in the long run. This effect has also caused the increase in the level of finished good inventory, and this has affected negatively the cash flow from operations. As for the cash, the company currently has 12 billion Mexican pesos on the balance sheet. This is the money that was raised in the IPO, and the main objective was or is to grow through M&As. In 2017, the company decided to pay a dividend of 51 cents per share. However, in this year, the company was not able to generate enough cash flow from its operations to cover this dividend and also the investment needs. Therefore, we believe that partially those dividends were paid with the proceeds raised on the IPO. This raises concerns about the decisions that are being taken regarding the dividend policy. Finally, we have the EBITDA margin and also the gross margin, which has slowed down and also declined in 2018. This is mainly caused by the prices of agave, which is the main raw material for the company, and those prices have been increasing in the last couple of years. There are no derivative contracts in the market to cover for this risk, and therefore the company has decided to follow a vertical integration strategy. Originally, the objective was to be integrated in a 90% degree by 2019. However, in the last conference call, the company decided to take down these guidelines, and they have not set a new deadline yet. Therefore, we believe that in the short and medium term, the financial results are going to be negatively affected.
For the evaluation, we focus on a discounted cash flow with two scenarios. Our base scenario that has 80% weight and our M&A optionality scenario that has 20% weight. This gives us a target price of 29.20 Mexican pesos with a downside of 0.68% to closing price in October 15th. For our base scenario, we have a target price of 27.60 that we got discounting cash flows from our WACC of 10.30% and a perpetuity growth rate of 4.10%. The WACC we calculated using the unlevered beta method, in where we use comparables from all around the world. Then we relevered the beta to Cuervo's target capital structure. Our risk-free rate is the Mexican 10-year bond plus a 25-point basis spread, anticipating for future raises in the interest rates. The market risk premium is 5.5% according to the Modern Equity Research. For our M&A optionality scenario, we have a target price of 35.40 Mexican pesos. For this scenario, we have revenue growth, and we utilize the Cuervo's excessive amount of cash. To calculate the impact of this growth, we took information from Cuervo's previous acquisition, Bushmills. We gave this scenario a low probability of happening because of the current outlook of Mexico, where the companies should be more cautious with the investments they make. For our Monte Carlo simulation, we have 68% probability of having a 29.2 Mexican pesos or less. We took two variables into consideration because we consider they are of high impact in our DCF. We took revenues, which is because there is a price in the bottle and the volume of the sales. And the other is cost of goods sold, because the agave is a very volatile raw material that currently has an upward trend, where it's currently selling at $24.50.
There are all the risk matrix that we found, and we will focus in three main risks. Country risk. Cuervo is headquartered in an emerging market where recent events have negative outlook for Mexico, and public consultation for investment decisions makes Mexico a country risk. In the operational risk, one key driver for Cuervo's profitability are the COGS, and is heavily impacted by the changes in the price of the raw materials. As we can see, from 2 years to now, there is an increment in the trend of the agave price.
1 minute.
For the regulatory risk, Cuervo relies on the appellation of the origin of the tequila that states that tequila must be made in Mexico. If countries stop to recognizing this, they can produce and sell their own tequila brand, as the case of China. Thank you very much for your attention, and please let us know your questions.
congratulations on your presentation. I'd like to know on your weighted average cost of capital, you have a cost of equity of 11.27, which is based on the risk-free rate of Mexico, which you're putting at 8.40 based on the 10-year rate plus a bit of a spread for hikes. But then the cost of debt for the company you have at 4.50. So if you could elaborate on that a bit.
Yes, we put the cost of debt at 4.50 because we are assuming the company will take another debt and they will to reach their optimal target capital structure, and we assume that the next debt will be around 550 and it make a weighted average in our debt in the debt of Cuervo right now that is 375, and 550 give us the new target debt.
That debt is based on the dollar bond, right?
Yes.
So you're kind of, on your WACC, you have a cost of debt in dollars from the bond plus a cost of equity in pesos.
Yes, but we added the market risk premium,
okay,
and that should make a point to having a dollarized cost of equity.
Okay, and just another question. You have a sell recommendation or a target price very close to the current trading price, or a valuation close to the trading price. So first would be, why not hold? And second would be, what would make you change your mind and say, you know, this should have been a buy?
Sure. We put a sell recommendation because when you compare your opportunities of investment here in Mexico, you see the Mexican CETE of 28 days right now at 8%. So if you give 8% to a CETE where you will have less risk, or you can invest in Cuervo that has more, higher implied risk, you would prefer to invest in the CETE instead of Cuervo, considering the target price is lower and does not give you a profit of 8% or more. And what would make us change our point of view to a buy would be to see results in the volume sold in United States, because we are confident that the premiumization will work, but the volumes need to keep up with the sales. If the volumes continue to go down, it's because the customer is not willing to pay for your product a high amount and would prefer to go to Don Julio or to Patron and spend or the same amount of money or less.
And also because in the second quarter of 2018, the revenues of the company were under the estimates, and we consider that it will be difficult for the company to get above the estimates of the revenues.
Thank you. Let me ask a very quick question. One of the risk factors you brought up was the free float of the company being quite low. How did you build that into your valuation? In other words, did you apply a risk premium as a result of that and adjust the valuation in a way? Just tell me what the impact was of the identifying that risk.
The free float per se here in Mexico, even though it's 15%, it's kind of high compared to the other companies. That's why Cuervo is in the IPC and it has a high volume. But when they have to go to assemblies and other stuff, then the majority of the stocks and the voting rights are in the Beckman family, so they can practically pass if they want to give a dividend when they shouldn't give a dividend, or they can take some not the best correct decision for the company in the long run because they need the money right now, or things per se.
Yeah, for example, in the case of the dividends, we mentioned that they paid dividends in 2017 when they didn't manage to raise or to gain enough money with the operation. And the same is happening in 2018. They are paying dividends, and however, they have an operating cash flow which is negative. So it doesn't make any sense and makes us think that maybe the family is using that control over the shares to pay dividends.
And so I get that. My question, I suppose, is how does that translate then into your analysis of the valuation of what the company's worth? So you've taken this factor and you said they're not behaving in a way that's shareholder friendly. That's what you're saying, or there's a risk. How do you translate that into the target price for your company? How do you adjust for that factor?
We did not take that into consideration.
What do you believe that reason for negative growth in the US market for company?
It's the overstock that happened in the three levels. When the company enters, gives their IPO and the roadshow, they talk about price raising in all of their products, and all of the customers in the United States that are divided in three levels overstock. So the three levels overstocked in the inventory, so they started to buy less because they did not have the demand, or because the prices of the bottles are higher and the people are buying less.
And also the competitors are much larger than Cuervo, than Becle. So we think that they have more resources maybe in the distribution channel, so they can reach easier these potential customers in the United States, and it's a bit maybe more difficult for Cuervo to get there.
So that makes it tougher even to grow in other markets, for example Asia, or that can compensate?
The company stated that they didn't want to go to Asia, that they wanted to grow in the United States and in the rest of the world that covers Australia and Europe. We believe the acquisition of Bushmills is also to have a entry barrier, to break an entry barrier and start providing their tequila in the UK.
And also the company started investing in other distributions, like the company Island to Island in Australia.
Okay, and is this a problem, this saturation or oversupply? It's a problem of the industry, or is just for Cuervo, for these brands? And also, how does this company compare to other companies in terms of valuation? Not just Cuervo by itself, but in terms of the industry. Is it cheap against others? Or?
In terms of multiple analysis, Cuervo is cheaper than Diageo or Ricard Pernod, that are their main competitors. But we believe that it's an issue that the overstock in every single level, it's only happening for Cuervo because Don Julio, Herradura, and Patron are showing growth quarter and quarter, year and year, and Cuervo is not losing market share, but they're just maintaining it, while the others are gaining territory to them. So that could affect them in the long run, because that means the customer is preferring the other brands than Cuervo.
Do you see this company as a target? And if you do, what will be your, will this change your recommendation or your valuation?
As a target to what, sorry?
To acquire.
To be acquired by another company.
If it would be, it obviously would change if we had the information that a company would want to buy Jose Cuervo as a company or any brand of Jose Cuervo. It could be a recommendation change to buy, because the brands are currently selling at high multiples, as the recent acquisition of Patron by Bacardi, that paid it in 25 times EBITDA. So if if Cuervo can sell Maestro Double or something like that to that kind of multiples, it would be a really nice cash.
Time? Okay, thank you.